Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Barb Armstrong, also an education coach, phenomenal educator, 20-plus year veteran of the financial markets, and a good friend. And she's going to be there to help answer your questions. Welcome to all of you, whether you're in the live session today, whether you're watching this in the recorded version. Either way, we're glad you're here. Barb's going to be there to help answer your questions in the chat. And if you're in the recorded session, participate in the discussion as well by leaving a comment in the comment section. We'll get to that as quickly as we can. So today's kind of interesting, right? We've got the Fed meeting going on today. Today is going to likely have a little bit of volatility. In fact, it's helped to kind of keep implied volatility elevated somewhat today because of that uncertainty created by the Fed, whether they do anything or not. That has led to some interesting circumstances in index options and index option premiums. And I'll show you what I mean by that here in just a minute. But then I hope today, if we can together kind of go down a path that I started thinking about last night when I was teaching the Advanced Options virtual workshop. Some of you were there. But it was around the idea of iron condors. So I had an iron condor idea on a very short term that I want you to explore with me, and we'll just go down that path and see what happens in this discussion. So for those of you who are joining us and who are brand new to trading index options, we've got lots of resources. For those of you that have been with us for a long time or you've been trading these strategies for a while, this is going to be an interesting exploration. But before we get started with all of that, let's talk a little bit about some of the housekeeping items that we need to take care of. One of those is the fact that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any account or strategy or particular symbol or anything else. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also remember that multiple leg option strategies will involve multiple transaction costs. With long options, investors may lose 100% of the funds involved. Also, remember that spread trades must be done, in most cases, in a margin account. Now, we're going to use some technical analysis here in this discussion. Technical analysis is not the only way to look at markets. It is theoretical in nature. It's not a guarantee, but neither is probability analysis nor fundamental analysis. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. Great learning environment, not a guarantee of future success out there. It doesn't facilitate early assignment of short options. But since we're talking about index options and we've been focusing our efforts on European style index options, that's not something that we need to really too much worry about because European style options can't be assigned early. Takes out that assignment risk. American style options can, and if you're in paper money, that doesn't happen. So be aware of that. Remember that investing involves risk, including loss of principal. And when we talk about stops, which we are going to do today, because we don't necessarily always do that, I want to talk about this. First of all, remember that stop orders do not guarantee the execution price or the price at which they get filled. They can simply allow us to specify the trigger price. And a stop limit order, we might risk being gapped around and the order not getting filled at all. So let's jump into this discussion by simply taking a look at one particular strategy. And we're going to talk a bit about a couple of things here because this is really kind of a combination of. So we're going to talk about an iron condor strategy today, which is a combination of a short call vertical and a short put vertical to create a neutral expectation, a neutral directional expectation in the same expiration date. And we're kind of balancing or hedging the risk of a stock or an index moving to a large degree one side or the other, because we know that at expiration, the price of that stock or the price of that index can't be both above and below both of the spreads in that iron condor. So it gives us kind of a range, a bracket around which we expect price to move. We've also been using vertical spreads, including, in this case, short vertical spreads, as a means to play directional movement and probability and time decay in our 14 days till expiration, 7 days till expiration strategy. And we'll look at that one first, and then we'll just jump into our Iron Condor strategy. But before we do that, let's pop over here to the Thinkorswim desktop software platform, see what's going on, see where implied volatility is, see what's elevating things and what's keeping things going. And at the moment, again, this is a good opportunity for me to remind you to click on subscribe down at the bottom of the page. Great way to stay connected to the Trader Talks webcast channel. It is a great way for not only you to have easier access to this material, but it benefits everybody else too, right? The more that you click on subscribe and like, the higher YouTube pops our content up in the algorithm, and the more other traders and investors and clients can gain access to this. So it helps you, it helps us, it's at no cost to you. Click on that subscribe button, and that's going to be helpful for everybody. So taking a look at the SPX, the S&P 500 here. Here we are on Fed Day, right? This is the day where probably nothing's going to happen in the Fed. But there's going to certainly be a lot of attention placed on the language in the Fed's press release and in the press conference. It's almost certain that every single word is going to be parsed for meaning and intent and what those future implications are, whether or not they leave, which the expectation is that they're going to leave rates alone. So everyone's looking to see, everyone hyperbolically, right, is looking to see if Chairman Powell is going to change his stance on data, change his stance on the likelihood of cutting rates going into further future meetings or not, and some sort of change perhaps to monetary policy. That's one of the reasons why I think over the course of the last 2 or 3 days, we've seen the SPX, we've seen the NDX, we've seen the Russell 2000 giving us these little tiny equilibrium type candles. And we're kind of stuck in the middle of this range in between the 50 and the 200 period simple moving averages on the SPX. We're going to get that information coming out just about noon Mountain Time, which is just about 2 o'clock to 2:15 Eastern Time is typically when that meeting comes out, and when that press conference and press statement is released. So that is a little ways ahead. Implied volatility still staying relatively elevated. We'll look at the VIX here in just a minute, because here's the SPX, kind of that sideways bound movement. And that's kind of the thought process that I want to get to here, is if the Fed leaves rates alone, which it's likely that they will do. Again, there's the possibility of something unusual happening, but it is likely that they leave rates alone. It's also very likely that we see the market just kind of sit still within this range until there is some maybe movement on tariff issues or other things. Again, not getting political, just kind of looking at this from the perception of what the market is looking for to drive movement. The market's run up to these resistance levels off of the 200 period moving average on both the S&P 500 and here on the NASDAQ, kind of sitting in this neutral range in between a previous level of what was resistance, now potentially support, and a new level of resistance, in this case, up around the 20,207, 208 range, and down here around the 19,530 or 520 range. So kind of right in that sideways channel here. Take a look at the Russell 2000, which arguably is perhaps a little bit more interest rate sensitive. So if there were a change to interest rates, this may be where that gets reflected more quickly. Also, though, perhaps seeing more impact from tariff issues just kind of coming home to roost in terms of revenue. What I happen to notice is kind of sitting, the Russell 2000 kind of sitting right along this line. So once, twice, 3 times, 4 times, 5 times, this is acting as a level of support, kind of coming right up into that confluence on the Russell 2000. So from an index perspective, we're kind of sitting right at this technical toggle point, if you will. Pat Mullally and I used to call this a technical toggle point, where if it flips above a level, something changes. If it flips below that level, something changes in the opposite direction. And I think that's kind of where we are here on the Russell 2000. So we're a lot of wait and see until maybe midday today. So now let's change our view to our VIX grid and taking a look at the VIX here, the volatility index. This is, remember, the Terrence, that was a 1-year daily chart that we were looking at. Yes, Pat looks a lot like Kenny Rogers, by the way. Now his hair's down to about to his collar. But taking a look at the VIX right now, the VIX is kind of sitting right around this 25 handle, just under the 25 handle, 2478. And it's really, you can kind of see where that VIX has, we saw the big tariff-driven spike in volatility notching up to that 60 handle, coming back down, and we're now seeing it kind of right in this range. It's holding there. The 30-period moving average that I've put on here is a 30-period moving average of the VIX, but the VIX in and of itself is a 30-day rolling average of in the money, at the money, out of the money option prices on SPX options. So when investors are buying hedging products, meaning they're buying SPX puts, for instance, or they are selling highly priced SPX calls, or they are buying SPX calls to speculate, or they're creating spreads like we've done in this class, that's going to change the price of those options. When they're buying lots of puts to protect, because that's what institutions typically tend to do, is buy SPX options to protect long stock portfolios, then the VIX goes up because those options become more expensive. They're in more demand. Well, we've seen that kind of bleed off a little bit here, but implied volatility is running below its 30-period average. However, we take a look at the VIX versus the VVIX. The VIX is what we were just looking at. The VVIX is the level of volatility of the VIX itself. And this tells us whether VIX is inexpensive or expensive. So we've talked about this before in this particular class and in other classes, that generally what happens is volatility runs a little bit more volatile than its VIX. So VVIX stays a little bit higher than the VIX. That indicates maybe a little bit more demand for those options and kind of pulling through that forward expectation. But when we get this circumstance where the VVIX, that's the white line here, when that is below the level of the VIX, that's roughly the equivalent of what we're kind of seeing here in this relationship between VIX being below its moving average. That suggests that volatility is inexpensive relative to where it has been. That's one of those things that doesn't happen very often. And you can see that on this particular chart over the course of the last year, that VVIX tends to, like I said, tends to run higher than VIX. That can often be a precursor to possible expansion of volatility. We've seen it a couple of times. We saw it back here when VVIX was lower, and then we saw an expansion of volatility. We see VVIX down here below VIX. Could be a possible expansion of volatility. But the thing is, this is a discrete known event, right? We know that the Fed meeting is coming out, and we're not seeing an elevation of the VIX necessarily, nor are we seeing an elevation of VVIX relative to the VIX. Boy, this is getting deep now, right? Because now we're thinking, wow, what is the intention? If an institution is not buying protection when protection is cheap, meaning it's not raining right now, and umbrellas are on sale because it's not raining and it doesn't look like it's likely to rain, do they really have a fear of a rainstorm coming? Or are we going to see a situation where if a rainstorm does come, they then have to panic and buy an umbrella at whatever price that umbrella is priced at? And that's oftentimes what happens with the VIX. But that also suggests that maybe there's not an expectation, given the fact that the Fed isn't likely to change interest rates, that we see much movement at all. Now, you're right, they might be offsides, right? They're kind of caught on the back foot. If you are a surfer, they're off foot is where their weight is placed at the moment, right? Or it's going to be a tsunami. Yeah, exactly. That's the thing. Just okay. You remember the Monty Python sketch? Nobody expects the Spanish Inquisition. By the way, it is the 50th anniversary of Monty Python and the Holy Grail today, apparently, I guess. I'm going to go to, maybe if I can convince somebody to go with me, go see it in the theater. That would be great to see Monty Python and the Holy Grail in the theater again. But nobody expects the Spanish Inquisition. That's the thing. When volatility is cheap, when volatility is low, well, that's when nobody expects the Spanish Inquisition, and then all of a sudden they burst in. So keep that in mind for possible expansion of volatility for some news event with volatility being cheap, that institutions are kind of caught off the back foot, expecting that there's not going to be much of a movement, and we see an expansion of volatility. So deep dive into VIX and VVIX. Volatility is relatively inexpensive at the moment, and it's not low. I mean, it's relative to where it normally is, which is down around the 15 handle. It's not low, but neither is it expansively high. It's kind of up in that elevated range, but it's kind of holding its own kind of stasis here at the moment. So let's see how we can play some of that expectation as we go into some of these strategies that we're going to talk about. So the next thing I want to do here really quickly, after that deep dive into this discussion, is I want to pop back over here to the monitor tab, and I want to take a look at our 14-day, 7-day index strategy that we've been doing on the SPX. And so for those of you who are brand new to this discussion, the idea behind this strategy is that we, 14 days to go until expiration, sell a spread, sell a short vertical on the SPX index options with the intent of buying them back at 7 days to go. So buying them back 1 day late or 1 week later, and then buying another 14-day to go at that point. The point being that if we're selling that vertical spread, whether it's a call spread, which is what we've been selling, or whether it's a put spread, which is what we might be selling, depending on how things move, doing that at an area where the index is not likely to be. The expectation is we're playing for volatility decrease and passage of time, and trying to capture, especially in a far out of the money option, a very rapid decrease in time value at the beginning of the life cycle of the trade, as opposed to waiting for it to take off all of that time decay towards the end of the trade. And I'll show you what I mean here really quickly. Yeah, there you go. See, I've been talking through it, Carol. So again, going up, kind of elevating at the moment. So here's what we've got. A week ago, we sold the 57.25, 57.50 call spread, 25 wide call spread on the SPX. And the idea was that we were selling where the index is not likely to be. We sold it for $4.20, relatively elevated because the VIX was higher at that point. It is currently holding its own. It has not, it's decayed a little bit, but implied volatility has kind of kept this elevated. So we're in a position where to buy it back, we're going to be buying it back for a little bit more than we paid for it to begin with. And that's part of this strategy, is that sometimes we're going to take those losses, right? Sometimes we're going to end up buying back that vertical spread for more than we paid for it, because the goal here is just doing this come what may. More winners ultimately than losers, but once in a while we're going to take these losing trades. So let's go to the charts again here. I'm going to change this grid to my index options grid. And by the way, this grid itself is in the description. The link for this grid is in the description for this particular webcast. I will also share this with you as well. So let me show you what we've got here. On the left-hand side, we've got a 1-year daily chart of, in this case, the SPX. And we've got a MACD histogram giving us a momentum indication. On the right-hand side, we've got a 3-month daily, just so that we can see a zoomed-in view, and we've got implied volatility. So now we've got also this probability of expiring cone, which gives us that 1 standard deviation range of movement from where the price of the index is. So what we've been doing is at each iteration of this trade, we've been looking to see where the crossing point is of our 14 days to go until expiration and that one standard deviation line, and selling a spread right about at that level. Now, our technical toggle point in terms of, do we choose a call spread, do we choose to sell a call spread, or do we choose to sell a put spread, has been whether or not the index is above or below the 200 period simple moving average. And we're still below the 200 period simple moving average, so we're still selling call spreads. We're still hedging against that downside movement. So we're still going to do that today because it's still below the 200 period moving average. So we're still looking at selling call spreads. So let's kind of look at how we might accomplish this. I'm going to go to the trade tab, and we're going to look at the SPX. So here we are on the SPX, and I'm going to close down these option chains. This is another position from another class, but here's what we're looking at. So here we are, 7 days to go until expiration. We sold this a week ago, right? We sold this call spread a week ago. Our new 14 days to go until expiration is the 21 May. So let's deal with this one first. Let's go to the 14 May expiration. I've got 50 strikes showing, so that's 25 up, 25 down from the at the money position, and I've got to scroll all the way down here. And in fact, because this is moving, I've got to add a little bit more. I've got to add maybe another 10 strikes or so, and let's see if we can get to both legs. Now we've got both legs. This is the one that we sold, the 57.25. This is the one that we bought, which is the 57.50. So you can start to see that was priced a little bit more earlier this morning. This is starting to come back in a little bit. We're starting to see some of that that decay happening here, and starting to see a little bit of a collapse in that extrinsic value, even with implied volatility kind of moving around. Now that the market's up and running and going, we're starting to see these spreads coming back in a little bit. We're also starting to see these being priced a little bit more closely. So what we're going to do, first of all, I'm going to go back to my monitor tab, and you can see that this is kind of bouncing around between $5.90 and $6 and maybe a little bit more to buy it back. So first thing that we're going to do is we are going to buy this vertical spread back. So right click, and I'm going to create a closing order, and I'm going to buy it back. Now we're going to see if we can work this for a little bit better than 620. A limit order says buy it back for that price or better. Hopefully we can get a little bit better as this bounces around, but I'm willing to spend up to, I'm going to lock this at about 620 right there and see if we can get it for $6.20 or better. You can see that this is kind of bouncing around a little bit. We'll make it 620. These are 5-cent increments in that pricing. So I'm going to click on that lock, make sure that lock is closed, and I'm going to click on confirm and send. We're going to read through this order, make sure that we know that we can close this out. So we're going to take a little bit of a loss on this trade. We're going to take theoretically about a $2 loss on the trade. We got it for $6.20. So we took about a $2 loss on this vertical spread. And that's okay. That's kind of what the come what may means, right? We're gonna take this trade off come what may, regardless of whether it's a loss or whether it's a win. You might manage it differently. Again, that's just simply the way that we're taking this trade for the understanding of the discussion. So now what we know is that our 14 days to go until expiration is the 21 May expiration. We're still going to sell a call spread because we're below the 200 period moving average. Here's my probability of expiring count. So I'm going to expand this side of the of my grid so that we see just this one, so that we can put in here our price that we're looking at selling. So I'm going to delete these lines that I've drawn here before, and we're going to come down here and we're going to put a time hack. I'm going to use my time line here, and we're going to go 21. So that's 5/21. That's 14 days to go until expiration. That's right there. And I'm going to say, all right, where is, change this back to a trend line, where is the intersection of those two lines? 58.85. So if implied volatility is contracted a little bit, that's going to say that that line is probably a little bit closer to where the price of the index is. When implied volatility is higher, right? When implied volatility is higher, this cone is going to be wider. That's what this probability of expiring cone is based on, is that implied volatility. So wider cone when implied volatility is higher, narrower cone when implied volatility is lower. And that kind of gives us that automatic definition of where that strike price might be. Now, you could roll it, exactly, you could. But and like I said, you might manage it differently than me. Great questions to ask. And Alex, great question. What delta might you consider managing that short strike? If that starts to get closer, maybe to a 30 delta or a 50 delta, then you might think about pulling that trade off. But the thing is, we're managing it come what may, which we just did. So now we're going to look for this 58. We're going to kind of put our number here, 58. I'm going to call it 58. Maybe that 58.85 strike. And let's see what that looks like on the option chain. Now, Isaiah asked the question, how do you add this probability to the chart? You go up to the gear or the flask icon up here, and you start typing in the word probability, and you put probability of expiring cone right there on your chart, and then you'll have that cone. Okay? So here's what I'm going to do. I'm going to go to the trade tab, and we're going to go to the 21 May expiration. I'm going to scroll down this option chain. I've got 60 strikes. That's going to be 30 up and 30 down. And we're looking for that 58.85. And I don't have it here on the chain yet. So I'm going to have to add strikes. So I'm going to add 100 strikes total. That's going to be 50 up and 50 down. And we'll see if we get to that 58.85. We might have to even add, nope, there it is. So this is where, as we start to get further out in the vast, deep regions of space here, we don't have a 58.85. I've got a 5900. I've got a 58.50. So let's see where that 58.50 puts us. That 58.50 is the 12-cent delta, all right? So we might even come even in a little bit from there. So I'm going to go back to the chart. We're going to zoom in on the chart, and we're going to kind of see where that level is. 58.80. Where's 58.50? It's going to be right there, 58.50. I want to check left to confirm what's going on to the right and see if 58.50 gives me anything that I can hang my hat on from a technical analysis standpoint. And if I look back here, there is a support level in that downtrend right about that 58.50 range. You see where that is? So we're detuning this range a little bit. We're kind of bringing that down a little bit to that 58.50 strike. Does that make sense? So here's my support level back here. This was a resistance right here. I'm using that now to kind of bring this back into a range where I have maybe even a little bit more liquidity and still basing it on technical analysis and probability. So I'm still kind of within that probable range. So we're going to come back here. We're going to say, where's that 58.50 strike? That is at the 12-cent delta. And so I'm going to sell the 58.50 and buy the 5900. And let's see what that looks like. Okay. Yeah, it does. Absolutely, Isaiah. Great question to ask. Does it work with selling short calls or put verticals as well? Absolutely, 100%. It's above and below the current price of the stock. So here's what I'm going to do. I'm going to look at selling the 58.50, and I'm going to then look at buying the 5900. Okay. And we're going to do that for a $4.80 credit. So $50 wide vertical spread. It's a little bit wider than we have in some cases been going, but that's okay because that's what the strikes that we have. So we've got a risk, right? Bringing in $485 absolute, meaning $4.85 times 100 shares. And our loss is the balance of that $50 wide vertical spread minus the premium that we bring in. But when does this get hit? Well, again, we're looking at taking advantage of that time decay, eating away at this. So let's look at the sensitivities from a math perspective here really quickly. I'm going to click on edit, and we'll look at this again for just a second and say, look, what are our delta numbers? I'm going to change my layout to delta theta vega. And we're going to see what this looks like. So 58.50 has a really low delta sensitivity, right? So that's going to have about an 8-cent delta sensitivity thereabout, or 6-cent delta sensitivity, just about. and it's going to have a pretty decent theta sensitivity. That's why this trade works to a certain extent, right? So if we think about it, our short leg is decaying away to the tune of $1.39, and we subtract from that 94 cents of theta. That means we've got about a 45-cent theta decrease in our premium every single day that goes by. That's going to slow down a little bit. It's more accelerated right now. As we get closer to expiration, that's going to slow down a little bit. I'll show you why in just a second. And it's got a pretty good Vega sensitivity here as well. But that's how we would do the math, is we would take the theta of the short leg, subtract from that the theta of the long leg, and that gives us the net theta of that particular position, that spread. So here's the reason why this works, and why we do what we're doing in this 14.7, right? So we're used to seeing this time decay curve for at the money options, right? That theta decrease, or that theta sensitivity increases as we get closer to expiration. But what normally happens with out of the money options, especially far out of the money options, is this curve looks more like this. It kind of inverts. Not that it rises, that's just me not being able to draw. But what this suggests is that that theta decrease, or that theta impact, comes primarily in the first kind of week of the lifespan of this option, instead of towards the end of the option. So that's why we're selling this and then buying it back at 7 days. We're playing this theta impact. So that's kind of the reasoning behind this particular trade. So let's come back over here and let's put this trade on. We've queued up the order. Let's read through the order, make sure that this is what we want to do, and we're going to send this off to our index options weekly group. All right. Now, the reward to risk is kind of skewed, right? But we kind of have to balance that by probability in this particular case. Yeah, a lot of different ways that we can do this, right? So I'm going to go ahead and click on send. We're going to fire that order off, and we'll see if we can sell it. We sold it for $4.90. Hopefully we can buy it back for less a week from now when we come back together next Wednesday. Now, the next strategy that I want to jump into is one that, again, this is kind of the interesting perspective. I'm going to take the NDX here. And this is kind of walking down this iron condor perspective. Now, remember, an iron condor, we just created a short vertical spread on SPX. And we did it far out of the money on the call side, expecting that it's not going to get anywhere near being touched by the movement of the index. And we're going to benefit simply from the passage of time and implied volatility falling. But we know that if we go shorter, right, that we can take advantage of the smaller amount of remaining time to go until expiration, and less possibility of this index moving in a large degree. So my thought was, what if, yes, we can do this to sell an iron condor. Sure you can. What if we were to do a 0 days till expiration iron condor on the NASDAQ, given the fact that if we go to the trade tab right here, look at the elevated implied volatility that we still have. This was up about 100% implied volatility earlier. Now it's about 50% implied volatility. What if we take advantage of that elevated implied volatility in the 0 day till expiration? That means this is going to expire today. And what if we create an iron condor around price movement, and the expectation is it just simply goes out worthless, right? It simply goes out worthless. Now, I don't often look at taking trades all the way to expiration, but in this particular case, I'm simply looking at this trade going out worthless. So what I'm going to use in this particular case is probability. And that probability of expiring cone is one way to do it. Delta is also another way to do it. And so what I'm going to do is I'm going to go right around, just for the sake of this discussion, I'm going to go right around the 10 delta on both sides. And I'm going to sell as close as I can, as close as I can. So Claudio, I just answered that question. So why were you doing 14.7 versus 32.7? theta drop is greatest on an out of the money option at the initial start of the trade, as opposed to 30 days to go until expiration. That's why, right? That theta decay happens because it's an out of the money option. Good question to ask. Great question. We'll follow up with that. All right, let's put this together really quick here and see how this works. I'm going to go to the 19,390. I'm going to sell the 19,390, which is the 10 delta, and I'm going to buy the 19,380. And let's see what we get for it. We get about 75 cents of credit, okay? And against a $10 risk in the trade. Cool. Okay, that doesn't seem like a lot, but we can do better. So now I'm going to go to the other side. So I'm selling the 19,380 or 19,390, and I'm buying the 19,380, creating the call vertical. Excuse me, this is the put vertical on this side. Now I'm going to go to the other side, and I'm going to go to the 10 delta on the call side. Now remember, we're trading index options and a European style index option, so there's no assignment risk in this particular case. That's why we're, in this particular case, looking at doing this as a 0 days till expiration trade. So I'm going to come to the 10 delta here, which is the 2,000 or the 20,020 strike, and I'm going to sell the 20,020 strike. Actually, it's moving in a little bit, so I'm going to sell the 20,010 strike, and I'm going to buy the 20,020 strike. Now we've got $1.75, $1.65 against that $10 risk. Okay, so risk to reward, not great, but we're at the 10 delta. Very low probability that this gets hit. Could it get hit? Absolutely. Let's right click and send this over to the Analyze tab and take a look at what this looks like on the Analyze tab. Now, if you're not using the Analyze tab, it's something that we've got some great webcasts that talk about. But let me kind of squish this around so that we can see it. So here's where our maximum risk exists at our long strikes, where if we look at our probability of expiring cone or probability of expiring range here, where the option is likely to be, this expires right here. So this is kind of the broad range of where the price of the index is likely to be today. So the maximum theoretical gain of this iron condor kind of falls in the bulk of that range. It would take an extended move one way or the other for this to put one side or the other out of them or in the money, in which case we would lose on one side, but we'd collect on the other side. So we're going to collect that premium up front. We're going to expect that this index is simply going to stay straight down the middle, and we're going to keep that credit. If it goes one side or the other, we're going to take that loss on the trade. So this is an either or. It really becomes binary because we're here at this 0 days till expiration, and our expectation is this is going to go out worthless. Now, remember, here's the thing, George, and that is gamma risk. But here's the thing. We know what that theta decay is. We know what the volatility sensitivity is in this particular case. Gamma is the scenario that could move this. But you know what? Because this is an index option, because of that lack of assignment capability or exercise capability, that gamma gets significantly lower. And that's just one of the natures of this index. So let's do this. I'm going to put my slices, I'm going to set my slices to my break-even points. That's right there and right there. Those are our break-even points. And I'm going to send those, set those slices to the chart, and we can see that range. That's where we expect this index to stay, given this trade and given that probability. So that's the range right here between 20,000 and 19,387 that we're expecting this index to stay within this range. We collect a couple of $100. The risk is we lose if this goes one side or the other. The potential is taking that theoretical maximum loss in the trade, right? Yeah, absolutely. We're playing this volatility collapse because the likelihood is implied volatility collapses and this gets significantly cheaper. So we're looking at taking this out. It is a low probability. Well, in this particular case, it's kind of a high probability trade, but in a low probability environment, if that makes sense. Because there is that possibility of the index making a big move, but not a huge possibility. So we're playing that elevated implied volatility. Let's see how this plays itself out. And then we'll come back and we'll break this down. We'll try it again next week. We've got a lot of things to talk about in this trading index options class. I wanted to introduce this and kind of explore this idea based on the fact that the index, the overall movement of the market, has kind of been stuck in this range. And so let's play that out and play this out because we have that possibility of trading a 0 DTE option. This option is going to be a winner or a loser at the end of today. I mean, it is a binary situation. So it's either going to go out worthless or it's going to go out at max loss or some loss, right? Yeah. And that's, Laura, one of the reasons why it could make money in this particular trade is that we expect that volatility is going to collapse based on that uncertainty event, the Fed meeting, taking that volatility, sucking that volatility out of the market, right? So there you go. To be fair, I'm just going to say this straight up. This is a strategy that if the index moves significantly because of some sort of black swan event, if Chairman Powell says something, there's the possibility that we could take a loss in this trade. But it's a managed loss. We know what our loss is. We've defined that loss, right? And we're not going to close this, Harry. We could put an order to close this down. We don't have to. We're going to either let this go out worthless or it's going to go out at a loss. We could, if we wanted to, we could come back over here to the monitor tab. And we haven't placed the trade yet. Gosh, I'm just talking and talking and talking. We haven't put the order in, have we? Okay, so let's do this. Let's click on confirm and send. Let's read through the order, make sure that we're aware of what we're doing and aware of any alerts. Thanks for keeping me honest here. And we're going to put this in our index options group. And we're going to click on send and we're going to fire that order off and we'll see if that fills for us. And we got $1.70 for it. So that's our maximum theoretical gain. Yeah, see, Dragon Rider, you guys keep me talking, and then I don't place the trade, and then we talk through. I do this in the futures class all the time. I end up talking through the order, and then it changes in price, and then it wasn't what I expected it to be to begin with. But I'll tell you what, I'll give us this. Let's do this. Let's come to this NDX order right here. So this is our iron condor. We sold it for $1.70. It's already started to move down. So I'll concede we could potentially take some of the trade, or we could take this trade off if it's done the majority of the work. This is something that Barb teaches, right? So $10 wide vertical spread minus $1.70 is going to be the max theoretical loss in this particular case. I'd never eat there. So Barb teaches in her trading a smaller account webcast, the idea, and also in her verticals webcast, the idea of closing a trade down when it's done the majority of the work that it can do, when it's done, say, for instance, 80% of the work that it can do for us. So let's do this. Let's open up our calculator here and go $1.70 minus 80% is 34 cents. We could close this trade out at 30. I'm going to say, let's close it at 30 cents. So I'm going to do this, right click, create closing order, and we'll buy this back. We'll put in an order to buy this back at a limit order. And we'll say we'll buy it back on a limit order at 30 cents or less if it gets down to that point. Then it's done the majority of the work that it can do. That way, if for some reason we get, after the meeting, we get a big slam down in applied volatility, and this just starts getting cheaper and cheaper, we could get out of the trade and be done with it even before the end of the day. But remember, this is a 0 days till expiration option. It does carry risk. Be aware of that. We've taught some classes regarding 0 DTE options, but this is in a managed or defined risk spread, and it's in a product that doesn't have early assignment risk. So that is something to pay attention to. So we're going to create this as a stop order, basically, or an exit order. It's a limit order to buy this spread back for 30 cents or less. That's taking it off when it's done the majority of the work that it can do for us. So there we go. Yeah, cool. So cool stuff, guys. My thanks to Barb Armstrong for helping out. Let's just quickly review. We'll go to the monitor tab. We sold this 0 DTE Iron Condor on the NDX, expecting that this is going to go out by the end of the day. And we adjusted our index option weekly strategy, our 14.7. We bought back our previous one and we sold another one, sold it for $4.90. It's now trading at $5.15. So it's pumping up a little bit in terms of premium. That's because this index has kind of gone up just a little bit today. Boy, this was kind of fun. I kind of like this. Thanks for all of your comments and discussion and engagement in this webcast. My thanks to Barb Armstrong. If you want to learn more about the strategy, right here on the Trader Talks webcast page, search for iron condors and look at that. You got Barb Armstrong teaching iron condors as real-world examples right there in her Trading a Smaller Account webcast. Thank you for joining us here. Click on subscribe and like if you haven't done so already. Remember to follow me and Barb on X. I'm at Ben Watson CS. Barb is at Barb Armstrong CS. And if you haven't already, join us tonight for our Advanced Options Virtual Workshop. Have a great day, everybody. We'll see you soon. Take care. Bye-bye.